Next up, we're going to talk about Walt Disney, which owns TV networks ABC and ESPN, theme parks and resorts, and the consumer products division. It has a market cap of $151 billion, a PE ratio of 17.4, and a dividend yield of 1.59%. So just going straight to sport here, ESPN is obviously a massive part of that business. It's done incredibly well. You know, it's sort of what we used to Super Sport here. They used to ESPN in the States. Huge money in the sporting world. But because now, for example, Facebook bid $620 million to show the Indian Premier League cricket.
Yep.
So now all of a sudden you've got outside bidders that can potentially stream this stuff, that's pushing the price up for this content. So ESPN now are having to pay a lot more for you know, the Super Bowl. Yep. and so on.
Well, because of the money that is there, I think you just mentioned comparing ESPN to SuperSport. I think when you go global, that's what you see. That's your sporting channel. And I think possibly the sporting channel is almost running throughout the whole day. So that is massive. And I think you've also seen in terms of their numbers looking very good. So I think there's lots of growth opportunity in there. I mean, you've looked at all the sports. Talk about the Indian Premier League from cricket. In the past, we used to watch cricket. Possibly there was a cricket season. Today, there's no cricket season. It's throughout the whole year, and more teams are coming through. There's more innovation coming through there. You had the T20 coming through. So certainly, I think the opportunity for growth there is enormous, and the sustainability for me is also immeasurable because you can see where the world is going. You can see in terms of our lifestyles, in terms of what we're doing, and the fact that, as we mentioned earlier, sport is actually a serious career now. It's no longer where you've got 3 months season break. You know, you better get a week break.
Well, let's have a look at the share price there, and it has bumbled along a little bit after a decent period. And I think a lot of that has to do with the competition of streaming coming in. So on the back of that, Disney actually a few months ago announced that they're going to start their own streaming business. You know, in this race for content, Disney are the leaders. You know, they've got incredible brands. You know, they've got Marvel, they've got the Star Wars brands, and then of course all the Disney characters.
World,
So they've decided to start their own streaming business, but at the same time, they've also got strong relationships with a lot of cable networks and so on, so they are sort of cannibalizing that kind of business. They've cut their deal with Netflix from 2019 forward. Do you think this is the right way to go about things in terms of taking on streaming themselves?
No, certainly. I think if you look in terms of the founder of Walt Disney himself, I mean, this is a guy who made the name out of animation and acting and all sorts of things. So certainly, I think from the origins, you're looking at guys who already, I don't believe that there are more people who are creative than actors. I just think that those animation like Mr. Bean, they're very, very good at what they do. I believe that they've been going through an expansion, and they're the most well-known brand from an entertainment perspective, both for obviously adults and kids, and I think they will continue to grow.
So you're sounding pretty positive on this
Very
one?
positive. I'll be hot on Disney.
Hot on Disney. I'm going to agree with you there. I think this recent bumbling along of the share price is a good buying opportunity. And in the race to content, they are the leaders at the moment. So